When we left off, we were talking about the difference between Apple's and Microsoft's return on equity in the spring of 2012. And we compared Microsoft's return on equity of 41.7 to Apple's 45.6, over double of what it was before. What happened? Well, equity multiplier. Here's a change. Microsoft went from 2 to 2.5. How'd they do that and why? Did Microsoft just take out more debt? Possibly. More debt could be one reason. Excuse my poor handwriting. I'm using a tablet for the first time. Second, Microsoft pays dividends. As you pay dividends, stockholders' equity decreases and the equity multiplier goes up. The other thing that probably happened is Microsoft has a stock buyback program. So, as they buy back stock, boy, that's messy. They reduce stockholders' equity, which increases the proportion of debt, increases the equity multiplier, and drives up the return on equity. What else has happened? Microsoft's total asset turnover has gone down. Apple's has gone up. Profit margins increase for both of them. Microsoft is up about 8%. Apple's up almost 10%. Huge change in this return on assets for Apple as a combination of the increase in margin and increase in turnover. They've more than doubled. Stayed the same with their equity multiplier. Now, how can Microsoft catch up to Apple's return on equity? Management could look at any of these components. Profit margin, increasing the profit margin. Profit margin is net income over revenue. Increase the total asset turnover. If they increase the total asset turnover to 5.7, that would give them a return on equity of about 46%. So that would do it. That would mean even keeping the same revenue, but reducing total assets. Okay. They could also increase that equity multiplier, which they may or may not want to do because of any risk factors. Now, let's identify the companies with 14% return on equities. What factor drives their return on equity compared to the other company? Well, here we have two companies in the 14% range. Fitch, which is a retail specialty store, and DreamWorks. Okay. They get there pretty different ways, don't they? Profit margins, look at DreamWorks. 21.9%. They're an entertainment firm. They have a lot of assets. Just think of the computer power. Total asset turnover. Your retail establishment has to be higher. It's Abercrombie. Return on assets, it's different, but that, not wildly. Return on equity or equity multiplier, not wildly different. But the driver for DreamWorks is the profit margin. Driver for Abercrombie, or the big difference between the two, is that total asset turnover. You'll need to do that in your paper. Okay, I'm going to break here again.